GM, good morning. Welcome to the Milk Road Show, the daily crypto show that's as automatic as Kobe's mid-range jumper. I'm your host, Jay Hamilton. It's Wednesday, February 19th, and we are live yet again. If you guys are joining us live, give me a what's up in the chat. Great to see you today. We are joined by the Bitwise boys, Ryan Rasmussen and Matt Hogan. Bitwise, one of the largest crypto funds in the world, managing some fantastic ETFs and some great index funds. Today, we're going to talk about Trump's exec orders and the shift in Washington. Is that a big enough catalyst to break the 4-year crypto cycle that we have seen happening over and over again? Could this cycle be different and extend into 2026 and beyond? We're going to ask that question and break that down with the boys. Also, we're going to take a look at what these guys believe is the most important chart in crypto right now and how that might give you an edge in your investments in the short term. Before we jump in, guys, we've got some big news. We are launching a Milk Road Show Telegram group because I want to chat with you guys directly on a regular day-to-day basis. I'm an investor. You guys are an investor. We want to get our edge and we want to support each other. So hit the link in the show notes, join the Telegram group. If you guys have a question for a guest, you can let us know. We'll ask them. All these things we'll be talking about on a regular basis there. Today's episode is brought to you by Bybit. You guys got to check out their new Trade GPT. It's an AI-powered assistant that makes token analysis super simple. Also, today's episode is brought to you by Crypto.com, one of my favorite crypto cards. Great perks, access to lounges, and so much more. Check it out in the show notes. Without further ado, Bitwise boys, welcome back to the show.
Thanks for having us. Excited to be here.
Thank you. Always excited to have you guys. I also like that we spelt boys with a Z. It kind of brings a little bit of edge to this group here. Okay, let's start with the big question that a lot of people have been batting around recently is the question that Matt you put out on Twitter a few weeks ago, which is the 4-year cycle over? Is it different? And this question gets brought up probably every 4-year cycle around this time. And so far it hasn't been different. So people are wondering if it's different this time. Before we jump into talking about is it different, Matt, could you just quickly explain what the 4-year cycle is and give us a little bit of context so we make sure that everybody understands it?
Yeah, 100%. One of my favorite topics. So historically, if you look at the returns of crypto, it has a marked 4-year cycle, 3 big up years, and then a pullback year. You can see it there. Started in 2011, 3 big up years, and then we got crushed in 2014 when Mt. Gox collapsed. 2015 through 2017, 3 big up years, and then crushed in 2018 during the ICO crackdown. So this is much discussed. I will say that a lot of people give the wrong explanation when they talk about why this cycle exists. They point to the Bitcoin halving, which coincidentally happens every 4 years. But you can look at this chart and you know that the Bitcoin halving doesn't happen at the start of these cycles. And people sort of tie themselves up in knots with this, 18-month delay. I just think it's wrong. From my view, the reason this cycle happens is there's a catalyst that gets the market excited. So in 2011, it was the launch of Coinbase. It's the first time retail investors could actually buy Bitcoin without having a PhD. And that brought a lot of new capital into the market, 3 big up years, massive bull run, leverage built up. The system got too big for its sort of infrastructural underpinnings and something broke. And then the leverage retreated. Same thing in 2015. That was the launch of Ethereum. People got all excited. We had the ICO boom, huge amount of leverage built up in the system. And then the SEC sort of broke the egg, the leverage flushed out, and it collapsed. So this is the same as any economic cycle, Jay. If you look at the economy, we get these bull and bear markets. The reason is something starts a bull market, leverage builds up, the system gets overhyped, and it collapses. Our view is that the current cycle started when Grayscale won its lawsuit against the SEC. That was March 2023. You can look at a chart. Crypto had been down, basically only held steady, and then started ripping. We think that this cycle is driven by mainstream investors coming into the market for the first time ever. And that chart would suggest that, maybe 2026 would be a pullback year. But as you hinted at in your suggestion, I actually don't think that is going to be the case. And we can talk about why if you're interested.
Yeah, definitely want to jump into why. So just because I think this chart is so great to really describe this, where we are right now in the cycle is, according to past cycles, 2025 would be a great year. We would continue to do well, and then we would see the pullback in 2026 if we followed this pattern. People for a long time have been saying this pattern can't continue forever. It will eventually change. It almost seems like a bit of a cheat code that it just keeps following this same pattern. What is making you think that this cycle could be different?
Yeah. So for one, I'm starting to see the same signs we've seen historically, right? Leverage is building up in the system. So to some extent, it's true. Companies are issuing debt to buy Bitcoin. You can see leverage building up in the derivatives market. So we see this classic cycle, but you can think of it as this like little wave that would naturally come down. But we had this tectonic election, and we have this crypto executive order that says crypto is now a national priority of the largest economy in the world to make a big thing. We have institutions that are now unleashed to come into this market. And I think this little natural 4-year cycle wave is going to look like a ripple on the water. And there is this tidal wave of institutional interest and institutional adoption coming that's just going to plow it over. Now, could we have volatility? Of course, we're going to have volatility. We're going to have the deleveraging process. But when you have like Goldman Sachs, JP Morgan, and pension funds and endowments and sovereign wealth funds coming into the market, none of that matters. It's just going to get washed over. So I think the cycle will continue. There'll be volatility, but I think it's going to continue. My guess is 2026 is an up year, to put a fine point on it.
Okay. And to be clear, 2025, you also believe is an up year.
2025 is going to be great. I think I know we're all dancing in despair at the Libra meme coin and the death of meme coins. My fundamental thesis on crypto is never built on meme coin pump and dump schemes. It was built on something more fundamental than that. And I think the bull market there is going to take over in a few weeks and move us substantially forward. So I think 2025 is going to be a good year. I think 2026 is going to be a good year. I think 2027 is going to be a good year. We haven't repealed pullbacks. Of course, there will be pullbacks, but this is the biggest cycle in crypto's history. If you think about the quantum of money that needs to come into the market, like $1 trillion needs to buy crypto. In past cycles, it was like $10 billion of retail investors wanted to buy. It's $1 trillion, 100x. So I think it's going to continue for a while.
Yeah, if I can just add to that, I think, one of the strong reasons why we believe this time is different is because that final wave in year 3, to Matt's point, it's not retail money this time. Retail's already in the market in a major way. And the institutional capital that we expect to flow in 2025 and then extended in 2026 is not only magnitudes larger than retail investors' capital, but also it's net long-term. It's not focused on short-term, as Matt mentioned, pump and dumps or just short-term gains. If you think about the last cycle, what happened at the end of year 3 that led us to year 4, a lot of that was NFT markets going crazy, altcoins going crazy, these CeFi lending platforms spitting up 25% APY on algorithmic stable coins, things like that. And that's not what the institutional investors that we speak to are excited about. It's not why they're so bullish on the future of crypto. It's the other things that Matt mentioned. It's this regulatory shift happening in the US, these new products that are available to institutional investors so they can allocate in their broader portfolios that 1%, 2%, 3%, which ultimately does add up to trillions of dollars in long-term capital. I think that's why this final push is an order of magnitude different than the final push we've seen in year 3 of prior cycles.
So Matt, you mentioned that you think in a few weeks we could see a pump. Where's that coming from? Why are you saying that?
Well, when you think about the recent cycle, like crypto's despair cycle has gotten much shorter. I know people have forgotten this, but we were in existential despair post Melania. Like the world was ending, then we completely forgot about it. And we saw, money come back in, and then we entered re-existential despair for Libra. And I feel like all of crypto thinks like, well, this is it. This is it. It's over. It's the end. We're all going to zero. We might as well quit. There's just nothing in history that suggests that's true. Ryan and I spend all our time talking to institutions about allocating to this space. I'm going to do 2 sessions immediately after this with large, multi-billion-dollar asset managers. They don't even know Libra happened. They're just plowing money into the space. I don't understand how you can be bearish when, Abu Dhabi just bought $500 million worth of Bitcoin, right? That versus yet another pump and dump meme coins. I'll take that 10 times. So I think we're going to forget this despair. I think the bull market forces are too strong. And, these coming months, April tends to be a great month in crypto. Things tend to repeat. I think by that time, we're going to be doing fine.
Ryan, you have anything to add? Or
yeah, I just would add one anecdote there as well. Matt mentioned that we spend a lot of our time on the road talking to institutional investors. About 2 weeks ago, I was on the road with one of the members of our distribution team. And in a matter of 3 days, we had 10 meetings with different RAs from all different sizes. Some manage 100 million, some manage more than $1 billion, some manage around 5 billion. And the common theme across all of these meetings that we had was twofold. One, not a single one of them asked about meme coins. And if you think about this was like right after Trump took office and Melania and Trump tokens kind of pumped and dumped, and they're just not thinking about it. They're not on crypto Twitter. They're not in the trenches like some of us are. And so they're just not thinking about it. What they are thinking about, the second theme that pulled through in those meetings, was they're trying to figure out how Bitcoin, Ethereum, Solana, these large market cap crypto assets fit into their portfolio over the long term.
Yeah, I would just build on that one more thing. Sorry, we can't shut up because we're so impassioned about it. The single best time to invest, and this is my experience being in this market for 8 years, the single best time to invest is when the short-term sentiment is bad and the long-term trends are good. And I've never felt a moment in the market where that is more true than it is right now. The short-term sentiment is so negative. The long-term view is so positive. That is always and forever opportunity for long-term investors.
Yeah, I'm going to use that as, I'm going to bring up the chart here that you have labeled the most important chart in crypto right now. It is exactly what you were just discussing, but Matt, I'll let you take us through this chart, what you're seeing.
Yeah, so this is our internal, Bitwise generated sentiment score. It looks at something like 35 different factors. And what we've circled here is that it's in despair. And this if you've been on crypto Twitter or you've been on Discords. I remember watching the David Sachs conference on YouTube, and I was listening to it and like cheering my heart out because the official administration was saying we have the right to self-sovereign crypto assets, said you could code in DeFi, said we're going to get a regulatory structure, we're going to study the US buying Bitcoin as a strategic reserve. I was through the moon. And then the cycle of comments on the right was just absolute existential despair because David Sachs didn't come in and fat finger 1 million Bitcoin, within an hour, right? And so just that dichotomy, that's why that chart is so important, because particularly if you're in my seat and you spend all your time with institutional investors, people are unanimously bullish. They look at the regulatory switch, they look at the flood of institutional capital, and they understand that those are just forces that cannot be denied. So it's important to remember for the institutional community that retail is in this state of despair, and vice versa. If you're on crypto Twitter and Discord only, you should know that there's another class of people managing, $100 trillion in assets who's looking at this thing and saying, how fast can I get in? And I think that's really an important dichotomy in the market right now.
Ryan, in your mind, why is sentiment so bad in the retail side?
Yeah, I think it's pretty much, many retail investors, particularly over the last 6 to 9 months, have seen enormous amounts of wealth be created via meme coins and altcoins in a matter of hours or days. And it's hard to fight the temptation to try to get in on that. So what I think we've seen a lot of retail investors do is skip past the Bitcoins and the Ethereum and the Solanas of the world even skip past the Sweez and Aptos and other L1s that have performed relatively well and go straight to these meme coins, which, as we say, pump and dump, very often. And so I think has happened is a ton of retail investors have chased gains and are down bad. There's this heat map that we looked at for year-to-date returns of crypto assets, and there's a few green spots, and it's mostly red. And those green spots are Bitcoin, Solana, XRP. Yeah, there's the chart right there. This shows, I think, why retail sentiment is so bad, because majority of retail investors today, I believe, are allocated to the reds here. And majority of them are not allocated to the greens. And that's the difference between where institutional capital is flowing and where retail capital has flowed for the past 6 to 9 months. And of course, the vibes are terrible when you're down 60, 70, 80% for half your portfolio or 3/4 of your portfolio. How could it not feel like we're at the end, despite Bitcoin being at 100K, despite there being not a single bearish thing that's happened since Trump took office as it relates to crypto? So I think that's the reason why retail sentiment is just so bad and why it's so disconnected with institutional sentiment.
Okay, so here's the big question: is who's right? Are the institutions right, or is retail right? Either of you guys can jump in.
Yeah, I mean, they're probably right. They're probably both right? The thing that retail is right about and is waking up and realizing is that the median crypto asset or meme coin is going to zero. And the thing institutions are right about is that the average crypto asset is going to 10x in the next 10 years, right? And the difference between that, the median being, if you take all of them and you invest equally, I think the majority of them are going to go to zero. But if you do it on a market cap weighted basis, I think the size of the crypto market is going to go from $3 to $30 trillion, right? But if you're choosing the wrong horses, you're right to be in despair, right? If you own meme coins, if you're speculating on 100x altcoins, I think a lot of that is going to go to zero. We've been here before. This is 2018 Redux. This is the ICO boom when people woke up to the reality that these things were all worth zero. And there was existential despair. But that didn't stop the Bitcoin train. It didn't stop the Ethereum train. It didn't stop the birth of Solana and new real projects. The same thing is true right now. So the average asset is on its way to zero. But if you're allocating to the better part of crypto, I think it's a tremendous opportunity. So I think they're both right.
Okay, so we've got this situation where retail is down bad. There's a lot of pain. Institutions are super positive and very bullish. To me, that's an edge. Does that say that's an opportunity? But the key is what you're saying, Matt, is it depends on which tokens you're investing in and how you're allocating. For you guys, when you're talking to institutions, what's the allocation that they're looking at? Are they just doing Bitcoin? Are they going into other tokens? And I kind of want to lead into what we talk a lot about on the show about, keep the allocation simple, right? Like invest 80% of your portfolio, Bitcoin, ETH, and Sol. I know it sounds boring and not exciting, but at least, the line I love to give is, look, at least if you held ETH this whole time, sure, you're not up, but you're not at zero and you're never going to zero. So, and I still feel pretty good about ETH, but would love to get your thoughts on portfolio allocation.
Yeah, I'm happy to take this one, and Matt can build on it from there. I think what's important to remember when we're talking to these institutional investors, these wealth managers, financial advisors, family offices, it's really a small portion of their overall portfolio that they're thinking about or are starting to allocate to crypto. And that's important because when you think about their day-to-day of managing their investments, they don't want to spend 2, 3, 4, 5 hours a day checking in on crypto markets, scrolling crypto Twitter, checking in, the trending tokens on CoinMarketCap or Coinbase. They just want to set and forget. And so I think that's important because when we talk to these investors, majority of them are asking about Bitcoin, Ethereum. I do get questions on XRP and Solana. More recently, I will say we got a ton of questions on XRP when I was on the road a couple of weeks ago, more than I've ever gotten talking to investors. And I think that's just a signal of these investors looking at, what are the bigger market cap assets? I think they're also looking at what assets will I be able to allocate to. You have to remember that a lot of these wealth managers are only able to invest client assets in ETFs, in certain products that are approved in the platforms they trade or clear or custody through. And because of that, they're really limited in what they can invest in, and they're limited in the capacity they have to monitor the crypto market. So they really want set and forget strategies. A lot of investors ask us how to build a crypto sleeve. Should it be that 80% Bitcoin, 10% Ethereum, 10% XRP? Should it be a market cap weighted approach? We think indexing is going to be a huge narrative over the next 2 years, in the same way that indexing is a huge part of traditional equity investing, and that many investors are going to want to just allocate to an index fund that tracks the top 10, 20, 30 crypto assets by market cap, rebalances, and follows a set of rules or a certain methodology. And that allows them to set and forget it and spend most of their time focused on what the majority of their portfolio is allocated to, which is equities and bonds and other alternative assets.
Yeah, I would just add on that. I love your, holy trinity of Bitcoin, ETH, and Solana as 80% of the portfolio. That also allows you to take real risks with the 20% of your portfolio. And, as I look at the market, I see some green shoots in areas that people aren't talking about, where I think you have early signs that we're going to get a substantial revaluation of these markets. So I think there's some exciting places to play with that 20%. But I agree completely with Ryan. The people we talk to basically just want to bet on crypto, which means an index-based portfolio. And it means a lot of Bitcoin. I know we don't like to talk about it. Bitcoin's 2/3 of the market, right? So if you're less than 2/3 Bitcoin in your portfolio, you're making a very specific active bet on altcoins. And I think that's hard for people to grok. But I do think there's some interesting areas for risk-on trading as well.
Okay, I got to naturally ask you that question, but before I do, Matt, you mentioned a few moments ago that we're at 3 trillion crypto market cap now. You think we're going to 30 trillion. We had Dan Tapiero on the show a few weeks ago. He said 50 trillion. He just launched his new fund, 50T. Raoul Paul likes to say 100 trillion. So we have these big numbers being thrown out there by incredibly smart, experienced investors who've been in the space for a long time. Where'd you get your 30 trillion number from? Is that, and what's the time frame that you market that on?
Yeah, I think, look, I think Bitcoin's going to be as big as gold in 5 or 6 years. That's $20 trillion right there. So that only leaves $10 trillion left. I think it's easy to look at the programmable blockchain space and suggest that if it's successful, so that's the important caveat. But if you think the world of finance is going to move over public blockchain rails, there's just no way it doesn't 10x, right? Like you have to get 100x more people onto this market. If you look at the coins people love to hate the most from a token economic perspective, like let's take XRP. If the number of people transactions on XRP 100x's, that blockchain is burning 1% of its supply per year. And I think it gets substantially revalued. And that's probably the most difficult token economic model to support. So if we export that to something like Solana or something like ETH or something like SUI with a more normalized token economic model that puts more value onto the underlying chain, and you 100x the users, how does it not 10x? So that gets to 30 trillion, right? Maybe Dan is right. Like, Bitcoin could be much more than that. It depends on our time frame. But I don't see a world where this market is successful and we're not at least at that kind of level. And that's sort of how I think about it.
Yeah. I also think that, Matt spoke about if the programmable blockchain ecosystem is successful in disrupting and overhauling the traditional financial system. What is that opportunity? 5 trillion, 10 trillion, could be something like that. But you start thinking about some of these other forecasts, like Raoul Paul is, very bullish on Web3 as a whole, disrupting many different industries. And I think that's when you start to get the even higher multiples, when you start to look at the different addressable markets that the broader programmable blockchain and crypto ecosystem is going after beyond just the gold market and the traditional financial ecosystem. And that's, where you get those really exciting numbers from that are, 50, 100 trillion.
Yeah. And the disrupting finance feels so obvious. How could it not happen? It is better technology that is cheaper and more profitable for these banks and these businesses. And and then we have regulation coming and the president who believes in it. So that feels obvious. The other stuff, the Web3 stuff, is definitely further down the road. So we'll see whether that stuff happens or not. Matt, question in the chat. I got to come back. You talked about some areas you see for green investment right now. What are they?
Yeah, so I'm looking at what are the early signals that the change in administration is going to reshape the market. And there are three that I've seen that really stand out to me. So one is just institutional investment into Bitcoin, right? Like if we look at the flows into ETFs since the administration came in, there's huge institutional investment. Flows are accelerating into ETFs. So I think Bitcoin is a very easy bet. The two other sort of green shoots that I noticed, Jupiter turned on a fee switch and all of a sudden is burning $100 million per year. That's really a notable fact to me. I don't think that would have happened 2 or 3 or 4 months ago because there's too much regulatory pressure. And that suggests to me that in the DeFi space, we're going to see protocols go from sort of this fuzzy economic value governance token to cash flow driven governance or cash flow driven tokenomics. And I think you're going to see a substantial revaluation of the DeFi space when we get away from these soft, squishy governance-based tokens to tokens that actually have real economic value. I didn't see many people talk about that, but I don't think that is a shift we would have seen in the past. The other sort of DeFi-related shift I saw was Ondo Finance talking about offering tokenized stocks to a global audience. That's not an announcement that they would have made pre-November or pre the January executive order. And I think that's another signal that we're going to see DeFi moving aggressively into traditional regulated markets. So the things people have been always dreaming about is actually starting to unfold. So I think DeFi is particularly attractive because I think it's suffered from this sort of weak connection to token value. And I think there are early signs that that's going to be reversed. And it's suffered from being willing to interact with the regulated world, which is, of course, orders of magnitude bigger than the crypto world. And I think there are early signs that that is going to happen as well. So Bitcoin, DeFi, and then, of course, you look at the growth of stablecoins. It's the little engine that could. So anything in the stablecoin ecosystem, I think, is an interesting area to think about. But those are a few areas I don't think people, talking enough about.
Ryan, anything that you're liking?
Well, I do think Matt has a really good point about DeFi, which has been has really gotten battered since the heights of the 2021 market. But I think DeFi is this really unique space right now where we're seeing, because of the regulatory shift that's happening and because of just the growth of the crypto ecosystem, we're seeing these DeFi protocols or experiments finally turn a corner and turn into real businesses. And I think an analogy to make there is when you had companies like Uber who were being fought by regulators in major cities that weren't able to grow their business, weren't able to deploy their business, it really hampered their growth. And I think what we're seeing today with protocols like Jupiter and Uniswap and DeFi protocols, DeFi lending protocols like Maker, you just saw Rune, the founder of Maker, put out a proposal to cut OpEx to zero by a certain date, right? These DeFi protocols now are finally seeing the opportunity where they can unleash new business models that, don't put them in the regulatory crosshairs because this new administration is more crypto friendly and is going to put clear rules and regulations in place for how these protocols can operate like companies. I think that's really bullish for the long-term growth of the DeFi sector, especially, those protocols like Uniswap, which is the most popular crypto application out there built on the blockchain, right? And now they're generating fees that are being distributed to stakers of the Uni token through the Uni chain, right? That's a new business model they're deploying, and they're able to do that with a little bit more confidence that they're not going to be hit with the Wells notice and sued by the SEC next month or 6 months from now. And that's going to allow investors to feel more comfortable investing in that token for the long term.
How do we save retail here? I feel like that's the position we're in here, because it just seems it seems so obvious. Like Bitcoin seems so obvious. I know maybe it's only like 1.5x from here. Maybe it's 2x, and maybe it's not the, is the 10 or the 100x that retail so desires. But it just, DeFi's, we've been talking about DeFi for years, and it seems so it is going to these protocols that have real revenues, that are really working, that have these very healthy tokenomics. You mentioned Jupiter. It is, and not to mention all of these DeFi protocols, a lot of them take advantage of meme coins because they're involved in the trading aspect of it. So it just feels so obvious, but I guess gamblers be gamblers. Like I don't know how do we help everybody not fall and trip on their own feet in this truly life-changing opportunity, right? Like you could be sitting here 5 years from now and you could have compounded and probably gotten 2x a year. Like I'm going to be really conservative here, and you'd be laughing. Or you could sit here and basically probably be down, be zero, maybe lost all your capital or not gone anywhere. And it just, I don't know. I just feel I want everyone to win.
100%. Yeah, I'd hate to see the people who have been in crypto through the difficult period fumble it at the 1 yard line, which I think you're seeing to some degree. Look, from my perspective, this is the single best time in history on a risk-adjusted basis to invest in crypto, because it's been so significantly de-risked. We're not going to get 10,000x returns, but it's been so significantly de-risked over the last year that on a risk-adjusted basis, there's never been a better moment. So I really love your keep most of your portfolio broadly based in crypto to make sure you capture this opportunity. You're going to be really sad if 10 years from now, crypto is enormous and you were early to this space, but you were only in meme coins or 1,000x efforts and you missed the boom. You don't want to do that. So keep most of your portfolio in broad-based crypto and then set aside 20%. Ryan and I do this as well, to invest in the things that you could 10 or 100x. I think that's pretty good way to approach it.
Yeah, I think there's a certain element of this where retail has to save itself in a certain way, because a lot of this is behavioral, right? You wouldn't walk into a casino, or you shouldn't walk into a casino and spend your entire paycheck week after week at the blackjack table, right? Many people love gambling. Some people love sports gambling. Some people like gambling at the casino, right? But doing it in a way where whatever you lose isn't going to force you to miss your rent payments and whatnot, I think is really important. I think that's the way to think about investing in these meme coins, is that a little can go a long way, but you shouldn't get lost in the narrative that meme coins are going to be the one thing that 10x's over the next 5 years. And so I think that's really important. And also I think macro will save retail a bit here. I mean, I think Trump wants lower interest rates. I think we'll get lower interest rates. You're seeing talks of Elon proposing a $5,000 stimulus to every American citizen, right? We saw, if that happens, we saw what happened to markets when we had stimulus back in the COVID era. So I think there's an element here where there could be some macro tailwinds that help save retail, and you get one of those rising tides scenarios. But most importantly, I think it's important to have a base to your portfolio, and then you can have shoots out from there, but don't really stray from those major crypto assets, which are going to transform the finance industry and other types of industries over the next 5 or 10 years.
Let's touch on macro quickly before we let you guys go, because this is the big thing that retail tends not to understand or to pay attention to. But it is, liquidity is the tide that lifts all ships. And as you said, Ryan, macro is probably going to save a lot of retail here. When we look at the current macro setup, we got a high US dollar. We had a high US dollar last time Trump came into office. So maybe history repeats itself if that comes out. We got China in crazy debt deflation. They got a crisis over there. So they need liquidity, but they can't put in liquidity because of the high US dollar. We got Trump talking tariffs, which maybe it's a negotiation tactic. Maybe it happens. How do you guys frame the current macro setup, and what do you think might happen throughout the rest of this year?
Brian, go ahead.
Yeah, I think we're in a period of uncertainty and chaos before we see green pastures ahead, is my honest take on it. And of course, markets hate uncertainty. And in times of uncertainty, investors sell liquid assets, and Bitcoin and crypto being 24/7, 365 liquid assets you can sell from your phone or computer, as opposed to stocks and equities, which are only traded during business hours, or other assets people might own, like real estate and other alternative investments. crypto is just there. It's easy to sell in times of uncertainty. Plus, it's a market where people take excess leverage. And so in times of uncertainty and in times of chaos, you do see these leverage flushes. You do see these bigger sell-offs on the weekends. For instance, when the tariffs were announced, you saw a major sell-off in crypto assets because you couldn't go sell Apple or Nvidia stock, right? And so I think you do get some extra uncertainty and choppiness in crypto markets from the macro. But I think long term, the tariff threats we've already seen are somewhat of a negotiation tactic. And Trump loves tariffs, has said he loves tariffs, but it's already been one of those threaten them and then pull back once you get what you want type situations. And I think we'll continue to see that back and forth happening. And ultimately, the fear of what tariffs could do to inflation or to the economy were likely overblown. I also think that just over the long term, we're going to see interest rates come down from where they're at today. And crypto is one of those asset classes that thrives in a low interest rate environment. Many of the investors that we speak to, for instance, who manage endowments and pension funds, were very happy allocating to treasuries when they could get 5-6% yields, but they're far less happy to do so when those yields are 1-2%, and they start chasing other types of returns. And that's when I think you start to see those 1-3% allocations to crypto from institutional investors, maybe even turn into 5% allocation. So I just think the macro environment right now is chaotic. And I think once the dust settles, there's so much that's been happening behind the scene to propel crypto assets higher that we get that kind of second wave or third wave of this bull market that I'm really excited about.
Yeah. I just add on that. I think it pays to think, what does Trump really want? That's how you see through the negotiation tactics. I think he wants a lower dollar to support U.S. manufacturing. I think he wants lower interest rates because he's a real estate guy and loves lower interest rates. And I think he wants big numbers. I think he wants the stock market to rip. And as a result, my guess is, while it's confusing and it's uncertain, what we're going to end up with is a lower dollar, lower interest rates, and inflation that's higher than expected, which causes the stock market to go up, which you get the big shiny numbers out there. And all three of those things are great for crypto. So again, I would look through the short-term issues to what the underlying sort of essence of what Donald Trump wants is. And when I do that, it looks like a positive environment to me long-term.
Yeah, I completely agree. Okay, last question before I let you guys go. And I realize this is a big question, so hopefully it doesn't, we can answer it short and quick. We talked yesterday with Eric Balkunas, and we were talking about the probability of the different ETFs coming this year. And he's giving basically Solana, XRP, DOGE, Litecoin, all above 70% chance of coming this year. So it seems likely, and I assume you guys have probably applied for a bunch of these ETFs. My question is, does it actually lead to flows? So let's assume these ETFs come. Let's assume we don't know necessarily which ones are coming, but Bitcoin is the big dog out there, and everybody wants Bitcoin. And it just feels like Ethereum never really went. And I'm wondering if we get all these other ETFs, is it going to matter? Is it going to lead to the flows that make a difference in the market?
Great question. Look, I think many of those, but not all of those, will be successful. And by successful, I mean gather a few $1 billion in assets. But it's not like you're going to get $100 billion into a, name your smaller blockchain. That's just not what is going to happen. I actually think the big dog is going to be an index product, right? If you look at the ownership of the Bitcoin ETFs, it's going from mostly retail. It's on its way to being mostly institutional. That's the marginal buyer. They're going to want to buy an index-based product. What that means for the market is the bigger you're going to get bigger, right? It goes to the winners. So look, I think all of those will be successful on their own. ETFs are considered successful, by the way, if they get above $100 million in assets. I think those ETFs that you named will probably all get above $100 million in assets, but they're not going to be $50 billion. That's just ridiculous. But I do think an index-based product is going to surprise. It's going to attract, I think tens of billions of dollars of assets. So that's what I would look at from a growth perspective, more so than the 10th largest crypto asset getting an ETP. Great, helpful, but not a game changer.
Mm-hmm. Do you guys have any index products right now?
We have an index based. So we yeah, I am talking my own book. I should probably
No. But I bring this up because like here's how we save retail. Go buy an index. Like this is the answer.
Yeah, we created the first crypto index fund. It's the largest in the world. It's called the Bitwise 10. The challenge is right now it's in a GBTC-like structure. So it trades at premiums and discounts, and it has a very high fee. We hope to convert it to an ETF, but right now there's not a good index-based solution for people. You have to do your own, right? Do it through Bitcoin and ETH, and then maybe hold direct some of the other assets, unless you can take on that volatility risk. But we've seen GBTC big premiums and discounts. The same thing applies to our product for now. But I do think we're going to get index-based solutions, and I think if that's where you park 80%, then you can go off like Ryan, be a complete degen, and try to speculate with your 20%. And at least enjoy the process, even if you lose out, and maybe you'll pick the right tokens as well.
Ryan, do we need a Ryan's Degen show to
Yeah.
talk about this more, or a counseling session?
Counseling.
I think a counseling
Let's talk
session. Yeah, makes sense. I don't think that would save retail. Let's just say that.
Gents, thanks so much for joining us today. Fabulous to have you on the show as always. Everybody listening in, let us know how you guys are feeling. Are you on the retail side of the sentiment right now, feeling bearish and feeling negative, or are you more on the institutional side where it's all vibes are good, bullish all around? Let us know. Matt, Ryan, thanks for joining us today.
Thanks for having us. Fun.
Thanks for listening in, everybody. Remember that none of this is financial advice. We are only here for entertainment purposes to give you guys the lowdown on what is happening in the markets every day. If you want to learn more, make sure you subscribe to the Milk Road newsletter and check out our new Telegram group. We'd love to see you there. We'll see you again tomorrow. Thanks for listening in, everybody. Have a wicked awesome day.